Why do market irrationalities happen in real estate investing? Imagine watching a property market suddenly surge in price, even though the fundamentals like rents and property values haven't changed. What causes these wild swings that seem to defy logic? Well, in real estate investing, market irrationalities happen because investors often make choices based on feelings, biases, and social influences rather than facts. These behaviors push prices away from what the property is truly worth, creating market gaps and sudden shifts. One big reason is herd mentality. When investors see others buying a certain neighborhood or property type, they jump in too, thinking it's the right move. This can cause prices to rise quickly, forming a bubble. But when sentiment shifts and everyone starts selling, prices can drop just as fast. Overconfidence and optimism bias also play a role. Many investors believe they can predict market movements or that their property will always go up in value. They tend to ignore risks, thinking negative events won't happen to them, which leads to taking bigger risks than they should. Confirmation bias is another factor. Investors tend to look for information that supports their existing beliefs about a market or property. They ignore signs that things might be changing or that their assumptions are wrong. Recency bias is also common. If prices have been rising steadily, investors often expect this trend to continue forever, even though markets naturally go through cycles. This can cause them to buy at high prices, expecting quick profits. The greater fool theory is a classic example. Investors buy overvalued properties hoping to sell to someone else at an even higher price, not because the property is worth it. This kind of speculation inflates prices beyond real value until the bubble bursts. And like stocks, real estate has higher transaction costs, lower liquidity, and longer holding periods. These factors limit the ability of rational investors to correct mispricings quickly, allowing irrational pricing to stick around longer. All these biases and behaviors interact with economic factors like interest rates, lending standards, and economic cycles. For example, during a housing boom, easy credit and rising prices fuel more buying, pushing prices further from their true value. When conditions change or sentiment shifts, panic selling can cause sharp declines. Understanding these irrationalities is key for real estate investors. When analyzing market trends and property values, it's important to look beyond just economic data. Recognizing when the market is driven by hype or fear helps investors spot opportunities to buy undervalued properties during downturns or avoid overhyped assets during booms. In the end, market irrationalities happen because investors are influenced by their emotions, social cues, and structural market limits. Being aware of these factors helps investors make smarter decisions and navigate the ups and downs of the real estate world more confidently.